What is going on, everybody? This is John Fibonacci of Trade House and of Trade House Houston. All right. Thanks, guys, for being here. I see that you guys are ready to, dive right into the lesson for today. You have to bear with me for a second because I'm a little nervous. All right. But before we get to the charts, and I'm going to let Yuri take over once I'm done. What you need to understand before we get to the charts is some context, because most of what we do is obviously the chart work, but it's the reasoning behind the chart work, right? It's the reasons that we have our targets, or the reasons that we have our entries, whether it be for imbalances or institutional candles, liquidity runs, and things like that. There's a reason for all of that. So I need to give you the context of why the divergence is so important, okay? Now, some people refer to this as relative strength analysis, okay? And that was passed down from generation to generation in terms of traders, okay? From legendary traders on to other traders on to us, okay? And now I'm passing it along to you, all right? When I look for a divergence, okay, I'm finding strength or weakness in the marketplace, okay? That's the whole point, all right? That's why it's called a relative strength analysis. But it's not relative strength index, okay? It's not indicator based, okay? What we're doing is we're comparing one asset to another, okay? Or even three assets at the same time or more. Okay, so for you note takers, okay, this is going to be important. All right, what you got to understand is that retail traders don't move price. Okay, we should all know that by now, but if you don't, it is what it is. Okay, we do not move price. The large money does. Okay, for example, the banks, the institutions, all right, and we put them under the umbrella of smart money. Now, if you don't exactly understand what smart money actually is, you can go to Investopedia.com. Okay, and I'll put that in the chat once I'm done presenting. Okay, and I'm going to ask you guys if you could just hold on to your questions right now. During the PowerPoint, I can't even click on the chat anyway, so just bear with me. Let's get through this, and then if you have any questions after that, we can deal with that. Okay. So we don't move price. All right. So the idea is to find smart money movements in the market and then figure out what they want to do with price. All right. If they are looking to be bullish, we want to be taking bullish trades. And inversely, right, if they are looking to be bearish, if they want to push price lower, then we want to be taking bearish positions, right? You don't want to go up against that trend, all right? You don't want to go against smart money. You want to be in alignment with them, okay? Using a divergence or finding a divergence helps determine what is weak and what is strong, okay? Excuse me. And we're going to get to the examples, and I'm going to show you why one is weak versus another one. Okay. And that's also defined as leaders and laggards. Okay. Which is also verifiable on Investopedia.com. Okay. So you can look that up as well. What we want to do, just like bullet point number 2, is we want to buy strength and sell weakness. And I know it sounds obvious, but if you don't have notes, right? If you're just, listening to me, kind of going along, you want to wait till we get to the charts, that's all fine and dandy. However, when the stream is over and you don't have access to me yet, right? Because I'm asleep or whatever, you're going to have questions. And if you don't have notes to refer to, or if you find a setup and you don't have notes to refer to, you're going to be lost. Okay. And, it's just going to be a waste of time. Okay. So it is what it is. All right. So what I do personally, okay, to make it easier, is I look at the line charts to find a divergence. And then I move back to either a bar chart or a candlestick chart. Okay. And those are the only three that I use. I don't use point and figures or Renko or anything like that. 99% of the time I am on candlesticks, and then the rest of it is split between the line chart and the bar chart. All right. Because the line chart is showing you the closing basis. Now, can I find a divergence without a line chart? Yes. But, we want to make things easy, right? So we just switch over to the line. All right. And that's that. A divergence, this is one of the most common questions I get, when people start looking for divergences, or they're posting their charts to say, hey, John, is this a divergence, right? A divergence should form in logical areas, right? Like post uptrends or downtrends, or possibly a price overextension. Now, that explanation is kind of vague, okay? And it is, because I don't have a specific number, right? I don't say, oh yeah, if there's a 500 pip move lower, then look for a divergence or something like that. I don't do that, okay? I pretty much eyeball the market, okay? And I'm not trying to show off or, put myself on a pedestal or anything like that. It's just, after doing this for a while, my name's John. I've been doing this for 6 years, okay? After doing this for a while, you just get used to it. And so you'll start to see that, oh yeah, price is overextended, or, we're nearing the end of an uptrend or downtrend. Okay. And that just comes with experience. All right. So there you have it. All right. Here is notes continued. One of the advantages of retail traders, that's us, okay, is that we can get in and out of the marketplace quickly, unlike the banks, okay? Since the banks have the most money, it takes them longest to get in or out of positions, okay? Remember, and I don't think I put this in here, but remember, the smart money, right? They predominantly dominate the weekly and daily timeframes. That's what they're trading off of, right? They're not, looking at a 1 minute chart or 5 minute charts. That's really more for the algorithms, okay? Which is a whole separate gem, by the way. So it takes them a long time to get into positions because their lot sizes are so big, or their positions, even in futures or stocks, their orders are so big, it has to be spread out over a couple days or a couple weeks or even a couple of months, okay? But an advantage that we have, since we have relatively small accounts, and I say relative meaning like relative to the size of a bank, okay? Even like $10 million to us, which would be a lot, is like nothing to a bank, okay? So that's what I meant by there. We can get in and out within a day or within a couple minutes, right? So we have that advantage to wait for them to show their hand. Once they show us their hand, then we can go in there and catch the caboose, right? That last part of the train before it starts to move, and we can hop on the back of that train and ride to profits, okay? Oh, that's what I got a little bit ahead of myself. No worries. Big trades take time, right? If you're not a patient person, you may need to work on that area of your personal development. Now, I put this in here not to talk trash, okay? I'm not trying to call you guys out. And as a matter of fact, just to prove a point, myself, I am not a patient person, okay? I'm not afraid to admit that, right? Sometimes I don't hold trades long enough, right? And I leave a lot on the table, or sometimes I miss trades. It happens, right? But that's something that I'm working on in my personal development. Guys, I want you to understand, even after 6 years, right? I've taken some trades that have 0 drawdown or less than 5 pips of drawdown, 100 pips of profit, things like that. That's all fine and dandy, but you should never stop learning. Okay. There's always something more, or always some type of personal development that you can be working on. And I know it doesn't really make sense to some folks who just want to learn price action and they don't want to like focus on themselves. And there is a strong correlation. Okay. Your attitude and your mindset doesn't move the markets, and that's true, but it your mindset and your personal development, they can affect your trades. Okay. Because you're the decision maker at the end of the day, right? So if you are lacking in that area, I strongly suggest you go ahead and work on that, just like I am. Okay. All right. So this is probably the most important part, because I normally just show people divergences and I let them figure it out after that. But I'm feeling a little bit generous. Okay. During this time of crisis, right? I want people to have the opportunity to get some razzle dazzle, if you will. So I may be missing steps. I'm not sure. This is the way that I do it. And this is how I did it on Zach McDonald's stream last week, where I called that Australian dollar short, which had less than 15 pips of drawdown and over 100 pips of profit within like an hour. Okay. And it was that big spike. And we actually may go over that. If I don't, I think Yuri will. So we'll get to that later. But the methodology that I did on that stream, if you weren't paying attention or if you haven't seen that stream, it's fine. I'll walk you through it. So first, I find the divergence and I expect the reversal. Okay. That's what's going to show me what smart money wants to do next. All right. And I'm not always going to catch the very high or very low. I'm usually getting in on a retracement or some type of mitigation. Okay. But the drawdown is very minimal. And this is how you minimize your risk to maximize your reward. Excuse me. Right. I could take a 15 pip stop for a 100 pip take profit. Right. And I know that sounds crazy. Maybe some of you haven't done that before. And I didn't do that, until after a while. But I'm telling you, it's possible. Okay. There are people who make money trading Forex. Okay. I just want you to know that. So then I wait, like I said, after the divergence is formed, I wait for mitigation. That comes back to the being a patient person, right? You have to be patient. You have to give that that market opportunity to wait, to form that mitigation, or to hit that mitigation candle, or to hit that imbalance, right? And there's other smart money concepts than just mitigation, right? We have those imbalances, or even a Fibonacci level and things like that, right? The quarters theory, stuff like that. So you would have to be aware of multiple smart money concepts, because not every divergence is going to give you necessarily a mitigation. It could be a run on a short-term high or low, right? And you can fade that. All right. So the trading should occur in alignment with time and price. Okay. That is also a very big gem. Okay. It is. Time and price usually means for intraday, right, is usually taking trades during the London session or during the London and New York overlap, right? Or sometimes I even fade the afternoon session when it comes to stocks, right? Whether it be like short covering or long exits and stuff like that. But I know you guys are Forex traders, so we'll probably end up sticking mostly with Forex today, okay? But we will branch out, and I know that for a fact, okay? But most of it will be Forex. And then, but time and price also is not just the time of the day. It could be the day of the week, right? So for example, if there's a divergence or a potential divergence forming on a Friday, right? I'm not going to take that trade, okay? Because it's Friday. I'm not going to enter a trade on a Friday. I'm just not going to do it. Now, say it's Tuesday or Wednesday, then yeah, that's a trade that I'm going to pull the trigger on, because it's a good day of the week. All right. For those of you who have a trade plan, you should kind of already be aware of that. And if you don't have a trade plan, well, you need to get one. Okay. And there's no other way to put that. So it is what it is. Outside of day of the week, it could be month of the year. And that might not make sense to anybody. But that usually comes from seasonality. Okay. I did a session on bounce back that explains seasonality. So we're not going to get into that today. But once you do understand what seasonality is, when you have a divergence that forms with seasonality, that's how you're going to get a 500 pip or more trade. Now, I'm not saying it's guaranteed. Okay. Nothing is guaranteed in the market, right? I'm not a licensed financial advisor. Okay. But when you back test, and that's what you should do, when you back test, you'll start to see that the divergence forms at major highs and major lows that turn the market for long periods of time. Okay. So with that being said, on a side note, we can show you the concepts, right? But 80% of your development as a trader, and this is true even for me, right? 80% or more of your growth as a trader, whether it be technical analysis or whatever, is going to come from what you do beyond the streams, right? Like when this stream is over, right? What are you going to go do next? I know most of you are probably going to go back into your charts and start looking for divergences, which is great. But what are you going to do tomorrow or the day after that or even a month from now, right? Are you just going to give up, or you got to dig into your charts? That is the only reason that made me who I am today, that I'm able to come on here and explain to you how I, slap the markets around, is because I spent the last 6 years doing that. All right. And I missed out on a lot, right? Because I stayed inside, didn't go to the clubs, didn't want to go drink. I drink sometimes, but you know what I'm saying, right? I stayed inside the house, got on the charts, and shut the door, turned the phone off, and just dove in. Okay. And that's what made me who I am. I'm not saying you have to be the same way. I actually don't recommend the way that I did it. It was kind of unhealthy, but it is what it is. All right. So I just want to let you guys know that your development is going to come from what you do once this is over. All right. So last part of the methodology is managing your risk, of course, and then again with the being patient part, right? Taking that trade and being patient enough to either let it pan out, right, or being patient enough to let it form. All right. So I hope you guys have noticed that we've covered patience quite a lot on this stream. Okay. So hope you're just aware of that. So what correlates or inverse correlates? Okay. And you'll see that when you get to the charts. What I like to look for is dollar and fiber, okay, which is the dollar index and the euro USD. Now that is a inverse correlation. They're generally going to be opposite of each other. Okay. And Yuri has some examples that he's going to show you, so you'll see what I'm talking about if you don't already know. All right. So I compare dollar index to euro USD. Now, why do I do that? If you go to, this is a terrible source, but it is what it is. If you go to Wikipedia and you look up what the dollar index actually is, you'll notice something about the euro that's different from the rest of the pairs or the rest of the currencies. I'm not going to tell you. Okay. You're going to have to go look that up for yourself, but trust me, you'll be glad that you did. Okay. I also look at the dollar index in cable, which is going to be GBP USD. Okay. Now it's not as strong as fiber, and it's been that way for, I think, the last 2, maybe 3 years. And I really think it's just because of Brexit. Prior to Brexit, it worked really well. But now that, Brexit occurred, they voted back in June 23rd of 2016. And since then, it really hasn't been the same. But you can still do it. But I just would much rather do euro than GBP. So those are my thoughts on that. Aussie and Kiwi, probably a favorite amongst the people who watched me do this on Rock Stream last year, the last few months of the year, back in 2019, where we did a lot on Aussie and Kiwi. So basically that's AUD USD and NZD USD. And yes, I use a lot of nicknames because trust me, it's so much easier to say Kiwi than it is to say NZD USD. All right. You don't have to write that down, but I strongly suggest it. Okay. I don't want to lose you when we start using a lot of the terminology. All right. Now, AUD and NZD, they correlate. Okay. Geographically, they're pretty close together. Fundamentally, they do a lot of the same stuff, imports, exports, whatever. So it is what it is. Even though they changed their interest rates at the end of the year, Aussie started dropping their interest rate, and I think NZD is a little bit higher. But at the time when we were doing those streams last year, they had the same interest rate. So everything was beautiful, right? And it was just divergence after divergence. We were calling tops, we were calling bottoms. It was amazing, right? Now they're still heavily correlated, but their interest rates are slightly different. So just be careful. All right, just be careful. My personal favorite, right, outside of Forex is the indices, right? S&P 500, Dow Jones, and NASDAQ, okay? I could probably do an entire stream on just those three, but we're not going to do that today. Maybe another time, all right? And then, of course, stocks to their respective benchmark or sector. That's what most people don't understand about the S&P 500 is that it's the most common used benchmark, right? Oh, if somebody has a hedge fund or if somebody has a mutual fund or something, they compare those gains to the overall market, which is the S&P 500. So if you had a hedge fund that promised me, say, 5% per year, which is trash, by the way, and I looked at the market and I saw the S&P 500 was gaining 10% per year, why would I put my money in your fund when I could put my money in the overall market? You see what I'm saying? So the S&P 500 is very, very important. And it's very important when we're trading the Dow Jones, which you guys know as US 30, right? So, and yes, you know, Forex, stocks, indices, commodities, whatever, it's all the same. I mean, they're different, of course, don't get me wrong. But when it comes to like smart money and these divergences, they're all the same, okay? The divergence does not discriminate, all right? And of course, now that I mentioned that, right, also gold and silver, okay, which Yuri, like I said, is going to get into the charts and show you, okay? So now I know some of you are dying to finally see a chart, right? You know, enough of the words, John. Let's get to the charts. I got you. We're gonna do that. Okay. So here's a screenshot that I took, I think, yesterday for this presentation specifically. So this is the Australian dollar with an overlap of NZD USD, right? We're looking at two charts at the same time, right? And I hope I didn't lose you, right? Some people, John, well, I'm struggling looking at one chart at one time. How can I look at two charts at the same time? Guys, it's very easy. Okay, well, at least that's my opinion. Trading isn't easy, but the divergence to me is easy. Okay, so what we're looking for is one asset to basically what's going to happen is that they're going to fall out of correlation, right? Let me see if my mouse is up here. When you notice they both fall at the same time, right? And they both go higher at the same time. So they both lower, higher, lower, higher, lower, right? They generally look exactly the same, right? Which is fine. But now, for those of you who don't know or haven't seen a divergence yet, now I'm going to expose you to what this is, okay? I believe the Australian dollar is the one in black, okay? So right here on the purple or pink line, I've annotated for you that the black line is going higher, right? It's making a higher high, right? Which is fine. But now at the same time, when you look at NZD, when you look at Kiwi, at the same time, it's actually making a lower high, right? So one makes a higher high, the other one makes a lower high. So that is a divergence. So when you realize that NZD, the one in blue, when it does not go higher like its respective peer, right? Its respective correlation. When it does not go higher like the other one, it goes lower. That is how you identify weakness. How do we know that it's weak? Well, if it failed to go higher and it went lower, isn't that what weakness is? Bearish pricing means it's moving lower, right? Okay. So when you see this in the marketplace, you would expect a sell-off for NZD. Now, since they are correlated, both of them would usually fall off. However, you would get more pips or points or percentage, however you want to measure it, out of the weaker one than you would the stronger one. Because if it's weak, it's going to fall more than its stronger peer. Okay. So I believe, yeah, that was it for the PowerPoint presentation. So let me just check the chat really quick. I know I'm nowhere near catching up to what you guys are saying. I'm gonna have to go back and look a little bit later because there's way too much for me to look at. I don't even know where to start. So I know Yuri's in there talking to you guys, giving you some insight. So let me just see. John Fibonacci on Instagram. Oh yeah, appreciate that, Mohammed. Yeah, my Instagram is at John Fibonacci. Give me a follow. I'll follow you back. It's all good, right? Answering. Appreciate that, Yuri. How do you get those two lines on your screen, separate currencies? Oh, I can do that for you as well. I forgot about that, actually. Thanks for reminding me. I will do that right now. Go to compare. Two pairs in one chart. Mohammed, you're wild. How about the, okay. So I forgot who asked it because it is what it is, but all right. So let me delete these over here then, and I'll show you how to manually add them to your chart. So let me actually go over to Australian dollar because that's what we had right up here. Let me delete everything. So again, right, I usually look at the candlesticks or sometimes the bar chart, right? So you just click on the line chart, it'll hop it over to the line, right? Easy. So this symbol right up in here is the compare or add symbol. It is a circle with a plus in it, right? Little plus sign. So you're going to click that. Now you either can add or compare, right? There's a slight difference. I think one, I don't know how to explain that. I'm gonna just let you do both. You could do the compare and then do the add, right? So when we add symbols, since we're looking at AUD USD, we're gonna need to look at Kiwi, right? So NZD USD, boom. Okay, now you have two lines on your chart. Can I add a third one and a fourth one and a fifth one? Yes, you can add as many as you want, I think, right? So I could get a whole bunch of lines on here. I'm not gonna do that, but that's how you add that. Right? So it's very easy. Okay. Let me check the chat one more time. Now we're up to 316 folks. So that's awesome. You're doing great, John. Thank you, Ryan. Thank you. I appreciate that. How do you know which divergence to choose if one has a higher high and one is different? How do you know it will sell and not do what the other one is doing? To choose one if one has a higher high and one is different, how do you know it will sell? Well, the trend for Aussie has been lower anyway. I mean, you can see this since, I mean, forever, right? The Aussie has been Some of you might be up from Australia, so I'm trying to pick my words carefully. The Australian dollar has been in a downtrend already, so the major overall trend is bearish anyway. Okay. So, and then I think you had another formation here, right? The blue is going lower, Aussie is going higher, and then the market reversed here. So, yes, major trend was bearish. So we just went to the smaller time frames and found another bearish divergence that aligned with the higher time frame. Okay. How would you not be mistaken that price will not go higher based on the strong pair? It's not necessarily strong, it's just stronger than its correlation. What we're doing is comparing one to the other. We're not comparing one to everything else. I'm not sure if I made sense on that or not. Just because it's strong still means it can go down, because these are still based both of these pairs are still compared to the US dollar. And you guys should already know the dollar has been rallying, right? The dollar has been very strong. So strong dollar, lower AUD, especially with a divergence. So I don't remember which time frame we were on. I guess it was either this or the 1 hour or the 4 hour. Either way it goes. Let's see. What time frame is best? All of them. All of the time frames. Every single time frame. Except the yearly chart. I rarely look at the yearly chart, and you're probably not going to have a divergence on the yearly chart, but I like the daily, the 1 hour, the 4 hour, 15-minute. I mean, it's all relative, right? Of course, there are other things, right? You know, like if we're at a daily institutional candle and you have a divergence that forms inside of that, oh my God, pull the trigger, you know? So everything that we do is replicatable on every single time frame. So it doesn't matter. I mean, it matters, but it really doesn't. I know that sounds crazy, but you'll just have to take my word for it. All right. Loving this call. Thank you. I appreciate that. John. Where's Zach and Jenna at? I don't know. Oh, I think they are from Australia. I'm not sure. I know Jenna is. I don't know about Zach. I haven't asked him that. Oh, thank you, John. That you are Australian. So awesome. Let me send them the recording. This Matt. Who said, would you correlate it with the overall trend of that pair as well? I'm not sure. I don't know if I understood that question correctly. I don't know. I'm just keep it moving. John, I never choose my words. I have to. I curse a lot, so I'm like trying to slow myself down so I don't curse and get in trouble a lot. You're welcome, Chris. Is there a bullish divergence? Absolutely. Yuri's going to show you some. Can you go over divergence between fiber and cable? Yeah, guys. Yuri is going to show you some more examples. Okay, I'm about to pass it to him in just a second. Just want to check the chat really quick. Now there's like I can't even keep up. Like you guys are just gonna swamp me with all these messages, so I can't even read all this. When you see divergence, how do we use that to? Okay, so I'm gonna do one example, and then I'll show you, or then I'm gonna pass it over to Yuri. So I'm gonna show you the example that I did with Zach McDonald, which was this exact one. Actually, I'm gonna put that back up there. So I went on stream, and when we saw this, price was trading lower, I think, into here. And so I said, hey, you know what? That's a divergence, and it formed in a logical area. How do we know that's a logical area? Well, uptrend. right? That's a terrible drawing. That's a little bit easier, right? We're in a uptrend. So price to me is overextended. Just because it's in an uptrend here doesn't necessarily mean we're not in a downtrend on the higher time frames. So this is a smaller retracement, okay? Potentially. I mean, I didn't know 100% when we saw it, but I did call the short. Now, why would I call a short position, right? So when let me just draw this real quick. So we're going to keep this here. Oh my goodness. We're going to keep this pink line here as a reminder that our divergence is there. Okay. That this pink line is going to remind us that the divergence is there. It's not a trend line or anything like that. Okay. So when we saw the market form the divergence and then sold off here, right? 1, 2, 3, 4, 5 candlesticks of solid down movement. And the up movement was very weak, right? Because it took 5 candles to go lower. And then it took like 10 candles to make it halfway back. So just looking at this, it's bearish, like stupid bearish, right? So what do we mark up, right? You guys know we mark up the institutional candles. So when we look at that, there's your short. What's the price on that? 6175. What was the price I gave on stream? 6175. Okay, so when the market returns to that, oh wow, you actually get a decent trade. Yes, it happens, right? So there, your entry here, my entry would have been there, right at 75. Like I said, my stop would have been at the top of the candle, at the top of this candle. Boom, there's your stop loss. Okay, where's your take profit? Well, you could have picked a new low, which obviously got hit later, or this is a 1 hour time frame. So if you got in and then it traded all the way back lower, I mean, that's over 100 pips right there. So you could have just taken profit at 100 pips and been done. So yes, that is mitigation. How do we know that's mitigation? Guys, look at that candle. Look at that candle. In 1 hour, it opened, it traded 118 pips higher and came back another 50 pips lower. Guys, that is not retail traders. That is not us. We're not doing that. That's smart money. What are they doing? They're mitigating out of this position. Also, they're running the equal highs right in here on the 15-minute. There's equal highs right here. What does retail think about equal highs, right? Oh, double top. That's a bearish thing. We should short it, right? So what happens when they have their stop losses? Where do they put them? Above equal highs. So not only, and this is how smart money actually is, because they took people out of their stop losses and mitigated out of their short positions to go lower. They did 2 razzle dazzles in 1 move. There was no news here. On April 1st, oh, April Fool's Day. Wow. Yeah. A lot of people got fooled over here, right? On April Fool's. Okay. So there was no news, right? Forex Factory, there was nothing on there. There was no interest rates. There was no cash rate, CPI, anything like that. So why would the market all of a sudden move 100 pips higher than 50 pips back lower when there was no news? Smart money. Smart money was behind that. That's how you know. Okay. So with that being said, I'm going to check the chat one more time, and then I'm going to give it over to Yuri, right? Yuri's been killing it. He's known about divergences for a while now. And his trading has been absolutely amazing. Sometimes, taking better trades than me. So definitely proud of Yuri and Ryan. Okay, they're both doing a fantastic job. So I'm going to hand it over to him in just a minute. Yeah, this is entirely too much to read. I'm sorry, guys. Yuri, if you're ready, I
Yeah,
will
I can hand it over
gladly
to
hand it
him.
over to you. Are you ready?
I can hand it over to him if you like.
Yeah, if you
Yep,
could.
that's fine.
Guys, thank you so much.